Good afternoon, all. My name is Balaram Vuchidi. Along with me, Narendra also is going to take the session. To start with, we are going to talk more about the accounting and then the additional requirements of accounting in terms of now because we have corporate tax in place and also we have to have a few reconciliations to be done to get to be comfortable with your books of accounts. So we just wanted to focus more on this primarily accounting area. So what all are important and then what is required to look at before you begin your first year of tax audit also we'll look at. So we'll have a transitional provisions discussed under corporate tax along with maintenance of books of accounts, what precautions you have to take care of, how do you update your books of accounts at the end of the month as well as at the end of the year, and what are the areas that are important to look at. So all those points will be discussed within this 1 to 1.5 hour session. We are Spectrum Auditing, Spectrum Accounting. We provide all the services like audit, accounting, corporate taxes, transfer pricing, company formation, ESR, economic substance regulation, and other compliances. So you can reach out to us if you need any other services in relation to this. So this is about the introduction. So as I mentioned, these are the topics that we are going to cover. Guidelines to prepare trial balance. Most of you know, I'm sure, but we just wanted to touch base on few important points which are relevant in a practical point of view. And the next we'll be talking about the importance of VAT reconciliation with books of accounts. So now, so far we've been maintaining books of accounts and also VAT has been there. So we were looking at that. But sometimes we do reconciliation, sometimes we do not. So it is important to reconcile both your books of accounts as well as your VAT records. Some of the ARPs or accounting packages they give you that reconciliation or give you the VAT report from that ERP itself, but some others may not. So it is always important to reconcile both. In addition to this, now we also need to make sure that we are in line with or aligned with corporate tax law requirements also. Plus, we have other compliances like economic substance regulation, then also anti-money laundering law compliance. So wherever you require to produce the numbers from your books of accounts, you need to make sure that the numbers are talking to each other. So that is why we need to have reconciliations on regular basis. Then we'll be talking about measures taken care by accountants to make records available for audit. So you regularly maintain your books of accounts, but at the end of the year, you need to close the books of accounts and make sure that the accounts are closed properly. And also, what are the precautions that you need to take care of to be ready for the audit? Now, in corporate tax era, so we are going to have audits mandatory for most of the companies when they have turnover more than 50 million dirhams, or if you are a company in free-zone company which is taking the benefit of 0% tax. Otherwise, also having audit is going to be useful, and it is important to have your books of accounts audited. And then last, we'll talk about the adjustment under transitional rules, and then actions to be action points you need to take care before your first tax period. For most of the companies, the first tax period has already begun, but from the point of view of books of accounts, or for being ready, what all are the important points that you need to look at. So these are the things that we will talk about. If you have any questions during the session, you can drop in as a message in the chat room. We'll try to address them during the session, or if not, at the end of the session, we'll have some time dedicated for Q&A, so we can discuss about them at the time of Q&A session. So yeah, this is what we'll be covering about. Narendra, so do you want to take it over? So Narendra will be handling the rest of the session until the last section of the session. Yeah, Narendra.
Good afternoon, all. Despite of your busy and hectic schedule, you have given us the opportunity to at least share some of the knowledge which you are known, but we want to. Sometimes we may know the advanced legislations from FTA to different types of professional houses, but we may miss to understand the basic item. So, through this webinar, we are trying to share with you guys the basics of accounting, and slowly we will increase the intention. So next step will be for the VAT reconciliation, and next how the auditors will look into your books, the GA and corporate tax adjustments. So let us start with guidelines to prepare trial balance. Yeah, so first of all, we must understand the importance of the chart of accounts. So chart of accounts are it's a business, it's a plan for a building. So we must know which item should be sitting under which place. So this will help in the following ways. It will help us to accurate the financial reporting. For example, if you don't know the proper grouping for your financial items, your report won't be proper. So as per IFRS conceptual framework, you must present fairly an entity shall present fairly its financial position and financial performance and cash flows. To achieve this, we must have the proper chart of accounts. So, I will tell you, if you misplace the expenses to a liability, then your financials are incorrect. So, for the accurate financial reporting, you must have the well organized chart of accounts. Next, efficient financial management. So, normally you should know the difference between an expense and the investment. Sometimes, if you spend some money, instead of recording it as an investment, if you record under expense, then your performance will be definitely deviate. So, to avoid those things, we must know what is the proper chart of accounts. So, it will help us to streamline the proper tracking of income, expenses, assets, and liabilities. And definitely, it will improve our reliability. As for IFRS 8 operating segments, we must know for the performance of the different segments in our entity. So, without this proper chart of accounts, you cannot achieve it. Next, ease of analysis. So, I will explain in this way. So, if you don't categorize the difference between the direct expenses and indirect expense, sometimes your gross profit will have the deviation. So, which means you cannot assess your proper performance. So most of the times people will get confused between the direct and indirect nature of the expenses. So if you have the strong base of chart of accounts, you can understand this and you can present a fair financial statements. Next, double entry system. So what is meant by double entry system? It is like a formula for accounting. So no debit can exist without a proper credit. So I can say like if there is a one debit, you must have equivalent opposite credit. I can say like uh, Newton's third law. Every action will be set an equivalent and opposite reaction. Like that, the whole accounting system will be based on the double entry system. So how it will help us? So our end of the day, our equation should match. Asset should be equal to liabilities plus equity. Equity is another form of liability. So whatever you are doing, end of the day, you should match the balance sheet item. So assets must be equal to liabilities plus equity. So different IFRS and IFRS conceptual framework also mention that an entity shall present fairly its financial position. To achieve this, you must follow this double entry system. So as I mentioned, these are the very basic concepts: double entry system and chart of accounts, accuracy and reliability. So if you don't know the proper meaning of this double entry system, sometimes you may record only, if the system allowing you to record only debit, then it will be a gone case. So it will be complete errors. The fundamental concept of accounting is gone away. So it will help us to reduce the errors. At the same time, it will enhance our accuracy and reliability. Next, and I cannot say it is important, it is an essential item, opening balances. Because without having the proper opening balances in the place, you cannot say the closing balances are correct. We will see how it is. So it will be acting like a foundation. So you cannot say the end point without knowing the starting point, right? So like that, for the trial balances, most of the times for the balance sheet items, opening balances are very, very important. So the recent enactment, the corporate tax is also demanding, even though the first financial year for the most of the organizations is from January 2024, they are strongly recommending that 31st December 2023 closing balances should be proper, which means again they are talking about the opening balances. That is the importance of the opening balances. It will be looking like very simple concept, but it is very important and relevant. Let us say, for example, if you don't know your customer balances for the previous year, how do you tell him the proper closing balance of data? How do you share the statement of account to him? So I just gave an example of data. For each and every ledger of the balance sheet item must have the proper closing balance of the previous year, which means the opening balance of the current year. So correct opening balances are very essential to determine the closing balances. So if you don't know about opening balances, sometimes, not sometimes, most of the cases, auditor will qualify the audit report. That we will see in the next slides. So the accurate OBBs ensure the reliability of subsequent balance sheets. As I mentioned, without knowing the starting point, you cannot say the closing balances are correct. At the same time, IFRS 1, first time adoption of International Financial Reporting Standards, also mandated this disclosure. Next, ledger scrutiny. So I will say I would recommend before giving to the auditor or before giving to the review or before preparation of any MIS reports, the ledger scrutiny is must. So we will try to keep some points here to let you know how to do a ledger scrutiny by ourselves. So it will be a little lengthy topic, so we can deal with this. So ensures completeness. So how it will help us? Ledger scrutiny means you must take it out your total trial balance for throughout the period, and you need to go through each and every line item. So which will help you to understand is there any misinformation or is there any mistake, that how to verify also we will discuss in the upcoming slides. So the basic understanding is we must verifying that all the transactions have been recorded in the ledgers. So for example, if you say 12 months period is our standard financial year, so you cannot record only 11 months expenses and say accounting is complete, right? So like that, we must record the transactions throughout the last day of the financial. Ensure that no transactions is omitted and maintaining comprehensive financial records. Maintains accuracy. As I mentioned, which it will help us to identify the errors, which will improve our reliability, right? So whenever if you are giving financial statement with 11 months or 10 months expenses, which means you are not presenting a fair presentation. Yeah. So here we will discuss what are some of the key aspects of ledger scrutiny. There are so many aspects, but these are very basic that no one should not forget. Yeah, transaction posting. Verify that all the transactions for the period are recorded. Here I mentioned period. If you are taking an year, it's an year. If you are taking to only quarter, it's a 3 months, or a half year, it's a 6 months, like that. I have mentioned period. So you must ensure that from the date of date of first to the last day of the period, you must record the transactions, whether it could be a bank statement, whether it could be a purchases, sales, whatever. Next, provisions and accruals. As for IFRS 9, you must record the proper provisions. So what is meant by provisions? Our primary concept of accounting is accrual. So we must do the accounting based on the accrual concept, which means, say for example, even though if you don't pay for a particular service, it doesn't mean that you don't book the expenses. I'll make it simple. That's why I'm telling this example. Say for example, during the last month of the financial year, say December, you may incur some expenses. Say for example, best is for the most of the companies, you may pay the salaries during the first week of January. That doesn't mean you will book the expenses during the first week of the January. So you should record those expenses. Likewise, if you know the if you know that a probable payment should be made for this period, in the next period, you must record all those expenses. For example, audit fees. You you know that those expenses are belonging to this year, you must record in this year. Like that, there are certain provisions and payables you must record. Next, revenue recognition. So as per IFRS 15, we must record the revenue based on this that standard. So most of the times we will record based on the invoices or based on the documents which are available. But sometimes it may not be correct. We must check the respective standard based on the nature of our organization. So it will be different recognition criteria are there for the different kinds of organizations or industry. So we must obey those rules and regulations. Next, expenses and revenue deferments. What by deferment? Just to it is an opposite for the provision. For example, how we are recording the expenses without being paid. Sometimes you may receive money in advance, but you should not record as a rent. Let us say an example of renting. For example, we are doing renting business. So sometimes customer came and given us the money for the upcoming 6 months, which means now we are in the month of December. So he paid us the money for next 6 months. Say, let us say 10,000 a month. So will you record all the 60,000 month of December? The answer is no. So despite of getting the bank receipt or cash receipt, you should not record the revenue in that particular period. You should record the respective revenue for that period, and remaining revenue you must defer. That is called deferment. And for the expenses also, sometimes if you don't found the matching revenue for that expenses, let us say for example preliminary expenses, you spent a huge amount of expenses, you may not record all those expenses in that particular period, right? To have that to match to aligning the matching concept. So in that case, we must defer the expenses also. So it is complete opposite to the provision deferment. Next, prepaid expenses. So most of in this country, the most prepaid common expenditure is the trade license expenses, because in order to start a business, you must spend almost 30K to 50K of dirhams of expenditure. So the benefit of those prepaid expenses will be deferred for at least minimum 12 months. Sometimes you may not open the trade license in the month of January. In such case, you must record those expenses under prepaid, and you must expense it out based on the period. Let us say you spent 24,000 in the month of April. So for that period, from April to December, if you say those are only 9 months, so you should not record the entire 24,000 in this year. So 24,000 divided by 12 into 9. So those 18,000 only we must record in this year, and remaining 6,000 we must defer to the next year. So which means the prepaid expenses for this period will be 6,000 and 18,000 will be the expenses for this period. That is all about the prepaid expenses. Like that, not only the trade license expenses, whatever. If you found that the benefit of these expenses will be deferred for more than this year, more than the current year, we must keep it under prepaid expenses. Next, third party balances. So third party balances here, I mean to say, sometimes we may miss some entries because of so and so reason. We may not getting the invoices or bills or something. So end of the period, at least a quarterly once, we must do the reconciliation. Could be with the bank, could be with the creditors or debtors. So we must get their respect to SOA. If you say bank, it is a bank statement. If you say creditors and debtors, it must be a statement of accounts from the respective party. So we must cross check with our ledger and their ledger. Thereby, you can reduce these kind of errors. Next, interbranch reconciliation. So in this landscape of UAE, so we found more than one entity. Related parties, or you may say branch, or for the purpose of activities, they may open one more trade license. So you will often see those kind of inter branches for the same company. In such case, if both branches are operating, you must reconcile the branch balances to be a proper, in order to have a proper related party disclosure or whatever. So one, just like how we are reconciling the debtors and creditors balances, one branch balance sheet should be matched with the another branch balances. If you are payable to one branch, the exact same amount should be receivable in another branch. Next, statutory balances. So the most ignored item, I cannot say. So generally we will miss the VAT, matching the VAT inputs with our books of accounts. Sometimes if the company is having dealing with only exports, they will have the input balances available with the VAT code. That balances should have in agreement with our book balances. So that we will discuss in the VAT reconciliation slides. So how to do and all. Next, current maturities of long-term debts. So normally, if you have trade term loans or any other loans, we must the upcoming periods principal repayment, upcoming 12 months principal repayments, we must record under current maturities of long-term debt, which will be more relevant to the audit procedure that we will discuss in the upcoming slides. And interest expense booking. In the same the term loan schedule, we will tend to book EMI as an expense. That is wrong. So EMI will contain the principal portion, at the same time interest portion. So we must we must remove the principal portion from the entire EMI, so that you can record only the interest expense to have a proper booking of interest expense. Next, the most important item as per IAS 16, property, plant and equipment, we must have the proper fixed asset register with us to know the full details of the asset, date of purchase, category of asset, useful life, depreciation for that year, and the carrying balance. So we must, it is a mandatory document for us, and depreciation. Next, gratuity provision. So one of the, as I mentioned, provision. So one of the important provision, and you cannot say no to this provision, which means for each and every employee, the Labor Act of UAE is demanding that we must pay the gratuity if he is served the respective period and he is leaving the organization. So it is a well-known liability for us. So definitely we must provide a provision without having any question or doubt. Sometimes it may demand the actuarial valuation to have a correct and approved liability of grant. Next, monthly comparison. So what is meant by monthly comparison? So if you keep your information, whether it is profit and loss account or trial balance or balance sheet, if you can prepare the monthly trial balance or monthly profit and loss, you can easily identify the mistakes. Let us say, for example, rent. If you keep it a monthly trial balance or monthly expenses, if it is anything got missed in any month, you can easily identify on a single site or single view. So that is the importance of monthly comparison. At least you will have the base. Okay, previous month we have this many expenses, and this month we don't have this many expenses. Why? So definitely it will alert you to check. That's why monthly comparison also essential. Next, expenses grouping. As I mentioned, sometimes for the manufacturing entities or any entities, we must be very careful on the gross margin and net margin. So gross margin means the total direct revenue minus cost of goods sold. Cost of goods sold doesn't mean only the purchases. It will include some more direct expenses like factory overhead or labor wages or factory rent, kind of direct expenses. So in such case, you cannot keep an indirect expenses or admin kind of expenses into direct expenses. So it will affect your gross margin. So that is also an important area. So yes, you are good enough to know this is an expense, but at the same time, you should be very uh, clever enough to decide whether this is direct expense or indirect expense. Next, the important element of the financials which will affect the both P&L and balance sheet, the closing stock. So closing stock statements are oftenly they will be it's like undervalued item or I don't know. So most of the organizations are doesn't maintain this closing stock statement, but it is strongly recommend we are strongly recommending that we should maintain the closing stock statements on daily basis so that there will be no deviations for anything. And how to value the closing stock. So as per IAS to inventories, you must go as per the rules and regulations mentioned over there. So sometimes, yeah, I can tell you the simple way. So you should value the closing stock with cost or net realizable value, whichever is lower. I will say simple example of gold. Let us say gold, as it is a daily varying item. You may purchase for 230 dirhams per gram, but by the time of year end, if it is reaching 250 per gram, still you need to value based on the cost or NRV, whichever is lower. But 250 is the most relevant value, but still you need to value at cost. That is our basic principles of it. Next, interest from fixed deposit. So this is also it's not a regular revenue for us, but it has a importance. So we may have some fixed deposits with banks. We must get confirmation from the banker, and we must recognize those interest into our income. Next, deposits to authorities. In this area of UAE, so most of the times government will ask you to keep some deposits for the various type of activities. That can be most of the times it will be authorities like DEVA, FEVA, or SEVA, some kind of authorities. You must check. For example, you may give a big amount of deposits. Sometimes those deposits you cannot get retrieved back. So those kind of deposits you must check whether deposits given to various authorities are inactive or not. That is important. And share capital. So sometimes we may forget to pass this entry because this country is not doesn't mandate a physical capital to keep in the books. It's just a book entry. So as per MOA, we must record the share capital entry. Right? Next, the most unimportant item for the all of the accountants or owners, the drawings. So owners can withdraw from the organization. So we must be very careful on where to keep these drawings, right? So most of the times, if they are personal in nature, we must record under shareholders current. Or if they have the fixed monthly remuneration as per the statute or as per the documentation, then you can keep it under remuneration or something. But if they are withdrawing for the personal purpose, you should not book under expenses. That is a very common and important item for the books of accounts. Next, group entity expenses. As I mentioned, this most of the companies have the group entities. Sometimes they will pay the other company's expenses from this company's pocket, and they will tend to record the same it as an expense. You should not record it as an expense. Instead, you should record as a receivable from the recipient entity. That is more important. So, just because you are paying to that particular purpose, it doesn't mean that is your expense. Your expense means it is exclusively for your company. So it may, which means you should record it as an asset, which will be receivable from that company. Whether it is receivable or not, that is a separate part. But on the first place, you should not be allowed to record it as an expense. You should be recorded as a asset, maybe advance given to some related party or whatever. Next, are we following accrual basis of accounting? As I mentioned during the first point, we must record the incomes and expenses for the period they occur, not when they receive, right? So, as per the accrual basis of accounting, we must record for the period. It doesn't mean that whether you received that or paid. It is based on the period that they incur, right? Next, bad debts provision. If you have any doubts on the receivables, you must create the bad debts as per IFRS 9, expected credit loss, to give a more accurate financial provision. Next, loan covenants. So most of the organizations will have the loans, and we must thoroughly verify the terms and conditions, because loan will come with different kinds of facilities. Not only simple loan, they will give sometimes cash credit, overdraft. So each one will have a different set of conditions. So accordingly, we must affect the books of accounts properly. Next, foreign currency transactions. Most of the banks will offer the AED account, USD account for the same thing. And if you receive any foreign currency, you must properly deal the foreign currency fluctuation. For example, I may say you have raised $10,000 to your US client. He will pay you $9,950. That 50 is, for example, bank charge. It should be borne by you based on the agreement between the bankers or something. So you should not record 9950. You should record the 10,000. If you record only 9950, that 50 will be showing as a receivable. Or for example, it may not be bank charge, it will be a foreign currency difference. You should recognize that foreign currency difference in that particular same time, so that your customer balances will be the same. Otherwise, at the end of the financial year, you may have the different balances and he may have the different balances. Again, there will be a conflict. Next, deferred tax. This will be the item which will be maybe will be coming into existence for the upcoming periods, as we have the corporate tax, which will be dealt in accordance with the IAS 12 income taxes, that we will discuss in our future webinars. But this is a very important item for the balance sheet. Next, amortization of intangibles. If we have any intangible assets, just like a PPEs, we must provide the amortization for the intangible assets also. Next, capital work in progress. If you have any CV, sometimes, as I mentioned, if you are most of the times for a construction business, the revenue will start after 2 or 3 years. But till then, if you spend any single penny, whether it is an expense, by nature it is expense, but still you must record under capital work in progress, even though if it is a small office expenses also, till you have starting the revenue. That is a capital work in progress. So you must, as per IAS 16, you must record under CV. You should not simply expense it out, which may lead to into losses. Right? You must record under CV, and you must recognize when to capitalize the same. That points you must be properly aware. And last but not least, automation and software. You should not go with a simple manual accounts like in earlier ages. So we must have a proper accounting software which will suit our needs. Yeah, this is all about the ledger scrutiny. So quickly we will jump to VAT reconciliation. So as I mentioned, VAT reconciliation is also an important aspect to take care during the accounting. So why? Sometimes you will give to your VAT professional who is filing on behalf of you. You may not give the full data because you also don't know why. Sometimes you may not get the invoices or purchase or bills or revenue items, any item, which is you may miss to provide the information to your VAT filing professional, which will lead to discrepancies. Why? Because if you are not maintaining proper books of accounts, if you are only just filing the VAT returns quarterly, then it may lead to a deviation. Because without seeing the proper bank statement, for example, if you have the proper set of books of accounts and if you are filing VAT return based on your books, then there are very less chances to get deviations between the original records and VAT records. And knowledge gaps. So definitely sometimes accountants or normal accountants or even some people may not aware of the proper rules of VAT claim. So they may take an ineligible VAT claim or VAT imports. So that will lead into a difference. So the upcoming slides, we will let you know how to do a reconciliation. We'll try to keep some idea what to do. But before that, there are some challenges. I will tell you. So normally our financial year books of accounts, our financial year will be starting from Jan to December or April to March. But it may not be necessary that your VAT financial year also will be starting for the same period. It may be from because VAT is having some different uh, regulations for the getting registered, right? So it may be a different period. In that way, you may face some challenges to reconcile the books with VAT. And the current system of FTA is not providing a detailed month-wise breakdown. It is giving you the full value for the quarter. So if you don't have the proper supporting for that filing, you may end up with uh, the problem while reconciling the books with the VAT. Next, revenue discrepancies. Not all the revenues of books may not be a revenue as per VAT. I mean to say some of them are out of scope sales, but which are revenue as per your books. So those are little challenges during the reconciliation. Yeah. So how to reconcile? So we must reconcile the sales, output VAT, and expenses, input VAT. How to verify the sales? Normally, if you see the box number 1, 4, and 5, we will have the standard rated sales, zero rated sales, exempted sales, and out of scope sales. Those are the items which we are mentioning in the return when filing the returns. That should be properly matched with our books of accounts. Next, output VAT. So whether output VAT as per our books of accounts is matching with the corresponding output VAT in the file return is important. Next, standard rated expenses. So in expenses, it is little impossible to track the expenses because for sales, most of the organizations will have only one or two ledgers, sales revenue or indirect income. But for expenses, the total book is expenses only, right? Direct expense, indirect expense, whatever. So it is little practically difficult to track those expenses. But for input VAT, you can track by simply visiting the input VAT ledger. So thereby you can reconcile this. For the format and all, we have clearly mentioned in our website. If you have interest, you can just download and you can use that template for the reconciliation of the VAT. But why it is important is in future, we don't know when FTA will come and ask why your financial turnover is having the deviation from the FTA turnover. So in such case, we must be ready with the proper reconciliation. Ready, because normally government may not give the proper time to respond. Next, additional considerations for the VAT. So VAT return filing frequency. As I mentioned, the challenges. So our filing frequency will not match with our financial period. That's why it will be a challenge for sometimes. And designated zones. There are n number of rules for the designated free zones as per VAT. So we must be properly, we must know whether the those transactions will be treated as out of scope or taxable sales. So it will be very an important consideration while doing the VAT filing. So next, reverse charge method. So we will, if you see the, if you are aware of the VAT filings, we must record the goods imported into UAE after clearing the goods with our TRN. We will record both in supplies as well as inputs, both in the column number 6 and 10. So we must be properly taking care. You should not consider it as a sales. But for the purpose of filing return only, we are mentioning the two columns. That is important. Next, VAT adjustments. While filing the VAT, sometimes it may found any mistakes by ourselves. We may keep some adjustments in our VAT. That also we need to take care properly while doing the returns. Yes. So next step, how auditor will look into your books. So we didn't keep all aspects of that auditor review. Just we will just try to keep, at least before going to an audit, how we need to make sure that our books are ready for an audit. Yes, again, as I mentioned, capital. So this capital must be in agreement with our base documents, our incorporation documents. It can be trade license or share certificates or amended memorandum and articles of association. For the time being, if you are changing any clauses of capital in memorandum, our capital balance should be agreed with that documents. Next, shareholders current account are retained in. So normally our statutory, there is a clause as per the law, we must keep some statutory reserve of 5%. It may not applicable for all the companies, but it is a provision. So this kind of basic requirements we must be taken care before going for audit. Non-current liabilities. Generally, sometimes we may forget the difference between the current liabilities and non-current liabilities. For example, employees and service benefits will also form part of non-current liability. Why? Because this gratuity you are not expecting that you will pay within the upcoming year. If we cannot expect that employee will leave by the next year. That's why it will form part of non-current liability. Next, long-term. So to invest in a long-term, in long-term items or long-term plans, first of all, your memorandum and your legal documents should support that. You cannot simply invest in the in a places where it is restricted by law or as per your documentation. So you must be careful while doing that investments. And at the same time, sometimes we will forget to recognize the accrued income. So, for example, if you invest in a, if you give loan to your related party, so it doesn't mean that you are giving a free. It will they, of course they won't pay any interest sometimes, but you must record a proper income for the investment. And investment should be valued properly on time to time basis. If they are not, if they are declining, you must provide a provision. That is a fundamental concept of accounting. And most important item, we must classify the investment. It should be investment in properties, investment in securities, investments in associates, investments in subsidiaries. Likewise, we should not keep a single figure as investment, just like an investment. So we must properly categorize. Next, long-term loans and advances. Whether the loans or advances are given to related parties with the proper approval and agreement for the terms and conditions. As I mentioned, so if you are providing any loans to your related parties, it must be properly backed with the agreements. with a nominal rate of interest and all. And you cannot classify the short-term loans and advance as a long-term loans and advances. Next, regarding cash and cash equivalents, if you have any fixed deposits, you must properly categorize under deposits. At the same time, as we discussed, the proper accounting of interest income also is important. And if they have any OD facilities, you must be properly reflected. You must get the proper certificate or statement from the banker before auditor is asking. You must be ready with those documentation. And fixed assets. Fixed assets, most often we will record the personal assets bought for the personal purposes under the books of accounts. You should not do the assets which are used for the personal purpose into books of accounts. And as I mentioned, you must record the intangible assets properly as per the policies. Next, contingent liabilities and commitments. So, what is meant by contingent liability? So, of course, it will not form a part in the direct books of account, but auditor will mention in the notes. That's why we must inform the auditor about these 6 items if you are come across with, let us say, maybe any for liquidated damage or penalties or warranties. At the point of time, you don't know how much penalty or warranty will come. Likewise, pending suits or claims against the company and bills discounted and letter of credit or guarantees and any guarantees given to subsidiary companies or related parties and any capital commitments and any disputes with the tax or government authorities, we don't know. At the time, you may not record in the books of account, but you must inform these things to the auditor in advance. Next, before asking by the auditor, we must record the revenue properly for the current year. Let us say, for example, we will be busy with the year-end closures. So at that time, we must be properly record the revenue which is belonging to the current year in the current year, which will be belonging to the succeeding year in the succeeding. For the purchase also same. You must not record the capital nature items into the purchase. For example, laptops, if you are trading the laptops, and of course, laptops is your stock in trade, it is a purchase. But those laptops which you are using for the purpose of office will not be your stock in trade. It will be your fixed assets. So that difference you must be properly given before auditor verifies and asks you. Okay, at the same time, the period you must be very careful. You must not record the previous to previous year purchase in this year and upcoming year's purchase in this year. Okay, and next most important item is managerial remuneration. So this managerial remuneration is the most common question by the auditor or even the owners also. So how they are getting remunerated, that is very important. So by the virtue of the ownership, they can withdraw whatever they want. But at the same time, it must be backed with the proper agreement. And the remuneration must be at arm's length basis. It doesn't mean that over and above arm's length basis, they cannot withdraw. They can still withdraw. But for the purpose of taxes or other statutory purposes, they may not treat them the full amount as a remuneration. They will treat only the market, only the agreed value as a remuneration. Other operating and administrative expenses. Sometimes auditor can question you. For example, you put insurance expenses. Let us say you have recorded all insurance expenses for the owners or their relatives into the company's books of accounts. He will easily catch, depending upon how many employees you have. He will cross check and he will identify. Visa expenses also. How many number of employees we have, based on that only, that visa expenses figure should be there. You cannot book the relatives of management or some other people's visa expenses into our books of accounts. Similarly, vehicle expenses also. How many vehicles we have? Auditor will have some idea on how to question the accountants and water and electricity charges, all. So it should be a reasonable expenses, right? Next, other income. So it is needless to mention that if at all we are getting some other revenue apart from our regular operations, we must be properly record those. It may be an interest from the banks or profit on sale of fixed assets or writing back the provisions, excessively created provisions, and one of the important items are sometimes maybe by virtue of the transaction or sometimes we may do the service which are not as per our approved activities. In such case, first of all, we should not do, which is illegal as per the laws of the UAE. You should not do the activities which are not there in your trade license. It is very strict in this region, but still, sometimes you need to do as a part of your regular operations. In such case, also you must properly record under other income with the proper. It should be supported with the proper. For example, if you are if it is VAT applicable, you must collect the VAT also. It doesn't mean that it is other income and negligible income. I cannot collect VAT. Then it will be a problem for us. And at the same time, foreign exchange gains. Sometimes we may get more money than what we raised due to the forex difference. We must record those incomes also properly. Next, this upcoming is transitional provisions. So how we must be careful before starting the first financial year as per the CT law.
Thank you, Narendra. So let's quickly look at the transitional provisions that are applicable. The transitional provisions are nothing but the provisions that will be applicable for your first tax period. But however, since the corporate tax was not there before, so what are the things that you need to take care of when you are moving from no tax period to a corporate tax period? So these are the transitional provisions that we need to look at. So one of the transitional provisions is to make sure that your closing balances of previous year, which will become opening balances for the next following year, which is nothing but the first tax period's opening balance. So those balances you need to look at them carefully. If you have any transactions with or balances outstanding with your related parties, so you need to make sure that those transactions are at arm's length, those balances are at arm's length. So if you're not done the transactions at arm's length, the balance, closing balance should be adjusted to bring it up to the arm's length value of the outstanding balances. That is one of the important one to look at. The other transitional provisions as per Ministerial Decision 120 is that you will be allowed to adjust your value of your gains or losses on sale of asset. So the reason is that since you had an asset which you purchased before the first tax period, which you will be continuing to use, and during the, I think it could be during first tax period or afterwards, you may be selling it. So when you sell it, whatever gain you get, so generally the entire gain is your profit. But for corporate tax purpose, because this asset was purchased before your corporate tax periods, so they want to give you a benefit to the extent of the gain that relates to your period before corporate tax was applicable to you. So they want to tax you only to that period of gain, a proportionate amount of gain, which is related to your tax period or tax regime period. And then just go back to previous slide. Yeah, so this is given to immovable properties, intangible assets, financial assets, and liabilities. So these are the only three categories of balance sheet items which are eligible to claim this particular transitional provision adjustment. So we'll discuss and what are the methods and how do we make the adjustment. But first of all, you need to have one of these assets, and then that asset should be owned by you before your first tax period. And those assets should always be measured at historical cost. So you should not be having a class of assets which are done in fair value. Those are not eligible. So these assets and liabilities should be only measured at historical cost basis on like throughout the life period of that particular asset. And you're planning to dispose or deemed to be disposed during or after first tax period for the value which is exceeding the net book value. So which means you're selling it at profit. And that sale of asset and liability is happening only either during first tax period or afterwards. So these are the things that we need to look at. Only if you are able to comply with these three conditions, then that particular asset is eligible for transitional provision adjustment. So the concept is that I have explained. So what do you adjust? What is the benefit? The benefit is that you exclude the amount of gain that would have arisen at the start of the first tax period had the qualifying immovable property been disposed of at market value and the cost of the qualifying immovable property was higher of the original cost or net book value. So they want to give you benefit of the gain for the period before the corporate tax came into existence or was applicable for you. So that particular gain portion, they don't want to tax. They only want to tax on the gain for the period relating to corporate tax regime. So that is a bottom line of this particular transitional provision adjustment. Now go to next slide. So there are a couple of options given. In addition to either you can just say that simply I want to tax the entire gain that I've earned out of the sale of the asset. That is straight away. There's no either adjustment will be there. But if at all if you want to go for this option, you want to adjust the gain related to period before corporate tax was applicable to you, then you have given the options. Options are like you have valuation method related to your market value, or the number of days proportion basis method is also given. So let us look at the valuation method, which is market value method. So under this method, how do you arrive to the adjustable value of your gain is what we are going to look at. So under this option one, the immovable property or intangible assets will be adjusted based on like your market value of the immovable property minus higher of original cost or net book value as on first day of tax period. So let us say that first day of tax period for your company is 1st January 2024. As we know, most of the companies, they have corporate tax applicability from January 24 onwards. So let us say your company also has got the same. So now you look at the market value of the immovable property as on that 1st January 2024. From that, you have to reduce the higher of the original cost. Original cost is the price that you paid to purchase that particular asset, or the net book value of the asset as on first day of tax period. So higher of these two should be reduced from your market value. How do you arrive to your market value? They have clearly mentioned that you have to get the asset valued by an approved valuer, and that approved valuer should be approved by the land department or respective authority of the Emirates, which is generally approved by the government or respective Emirates government to do the valuation of the properties. So that valuation should be done for the period as on the first day of your first tax period, which is again 1st January 2024. So market value as on 1st January 2024 minus higher of original cost or net book value as on 1st January 2024. So this gives you the amount of the gain which you can adjust against the gain that you arrive out of your sale proceed. So example, if you see, let's say the market value as on 1st January was 100,000 dirhams. So, so from this you have to reduce higher of original cost or net book value. Let's say original cost was 60,000 dirhams and net book value as on 1st January 24 was 30,000 dirhams. So out of these two numbers, the higher value is 60,000 dirhams, obviously. So which means you will be deducting 60,000 dirhams from 100,000 dirhams of market value. So that gives you 40,000 dirhams of gain or value, which you can adjust again as the total gain. What is the total gain? Generally, your sale proceeds minus original cost. Sale proceeds minus your net book value. So if you're selling this property at 200,000 dirhams, whenever it could be like Let's say that you're selling it at maybe 2025. You're selling it. Let's say the value of the sale proceeds from that sale is about 150,000. Okay, so 150,000 your sale proceed. Out of that, let's say net book value as on that date is about 20,000 dirhams. So 150 minus 20,000 dirhams gives you 130,000 dirhams. So 130,000 dirhams is your total gain. That is generally subject to tax in normal course of action. But since you have this transitional provision adjustment, according to which you got 60,000 value, sorry, 40,000 value, which is here, as an adjustable value. So 130,000, which is total gain, minus 40,000 dirhams, which is adjustable gain, which is nothing but the portion of the gain relating to period before corporate tax was applicable to you. So 130 minus 40, so net amount of 90,000. So that 90,000, which is net gain, is going to be subject to tax, but not entire 130,000. So that is what is the benefit that we are going to get out of this transitional provision adjustment. Next slide. So that was option one. Option two, that is given for time apportionment method. So the objective is say how to arrive to the adjustment value or adjustable value. Only the options given are different and the options available for different category of assets are different. So under this option two of the time apportionment method, you will have to arrive to two components. We'll see what are those components, component A and component B. So component A is nothing but sale proceeds less higher of the original cost or net book value at the start of the first tax period. So it is similar to what we have seen earlier. Here we are looking at sale proceeds. So whatever sale proceeds you received, from that amount you have to deduct other original cost or net book value, whichever is higher. That gives you component A. Then component B is about the period. So component B is going to be your divide the number of days qualifying own property by days before first tax period with total number of days. So this component B is going to be the numerator will be days before first tax period and denominator will be total number of days that you own that particular asset. So this is going to be a component B. So component A, sale proceeds minus higher of original cost and net book value. And component B is number of days, which is nothing but days before your first tax period divided by total number of days you own that asset. So A multiplied by B will give you the adjustable value of a gain amount. So that gain will be deducted from your total gain and the net amount will be subject to tax. So if you take an example, let's say adjustment component A is 80,000. So let's say your sale proceeds minus higher of your original or net book value is about 80,000 dirhams. Now let's compute component B, which is nothing but if you assume to have your asset purchased on 1st January 2023 and you sold the asset on let's say 1st April 2024. Now we have to arrive to the number of days. First component or first number or numerator is going to be days that you own the asset before first tax period. Since you purchased on 1st January 2023, and for you the first tax period is 1st January 2024, if you assume. So you want for the period before your first tax period is about 1 year, which is nothing but 365 days. Since you sold the asset on 1st April 2024, so the denominator is going to be your total period that you own that particular asset, which is nothing but date on when you purchase the asset, which is 1st January 2023, to the date on which you sold the asset, which is 1st April 2024. The total number of days that you own that asset is 457, out of which 365 days was the period before your first tax period. So you're going to multiply this 80,000 with this multiplier of B, which is nothing but 80,000 into 365 days divided by 457 days. So this gives you the amount which is adjustable against your total gain, which is nothing but 63,895. So 63,895 is your adjustable value of the gain. So you will be subject to tax only the net amount after deducting this particular gain or adjustable factor. So this is how it is going to be. So in this, what you're trying to do is you are trying to eliminate or reduce or exclude the gain which is pertaining to your period before your tax period. So that is what we are trying to do. So this is the advantage to the taxpayers. If you have an asset before your first tax period and selling that asset afterwards, whatever total gain that you're getting out of that, you will reduce this amount of adjustable value, and you will be subject to tax only under the net amount. Okay, so these are the two options available. The other one is like you directly you can say that I want to have my total gain subject to tax, which is nothing but total gain that you arrived will be subject to tax under that method. So these are the methods that are available, and the important thing is that you have to uh, obtain or decide whether you want to go for this transitional provision or you want to be subject to tax at normal like total gain or not. So that decision you have to make and give your or select your decision when you submit your first tax return. So your first corporate tax return filing is going to be important because you'll be asked to select whether you want to go for this transitional provision adjustment or you don't want to. So that option you have to select in your first tax return. So it is important to decide before that, and then be ready to take care of it on your in your first tax return. Next slide. So in addition to that, some of the key points before we commence our first tax period. Of course, most of the companies have their first tax period being there, but at least it is important to look at least if you have to make sure or take some precautions now itself, can you do something? First point is assess the recognition of relevant items in the closing balance of corporate tax. As I mentioned, your closing balances need to be looked at, and you make sure that whatever closing balances of previous period are correct and they are not overstated, neither understated. They are exactly correct amounts because any adjustments that you have to make subsequent to this or during first tax period or later, that is going to impact your profit and loss account also, which means it is going to impact your taxable income and also tax amount. So that is the reason why your 2023 closing balances, which is generally for most of the companies in the last financial year before you get into tax regime. So 2023 closing balances, you need to make sure that you review all your assets, you review all your liabilities. Make sure that your provisions, your accruals, your prepayments, all of them are correctly updated. And your closing balance is proper. Plus, in addition to that, your TP transitional impact, like no any balance that you are payable or received from your related parties, whether that balance is at arm's length or not. Your closing balance of previous year should be at arm's length so that your opening balance of the following year is correct. And most importantly, if you have any closing balances which you are making an adjustment in the subsequent periods will have impact on your tax amount. So that is the reason why you need to make sure that they are at arm's length. Assess the requirement of separate financials and carving out of transactions for PE branches, qualifying free zones, and tax groupings also. So so far it was fine when you have group entities to do your transactions or accounting of those transactions in your books of accounts in whichever way you're reasonably able to do. But now, for under corporate tax purpose, each entity will be treated as a separate taxable person unless you register them as a tax group. So when you have group entities which are not formed as tax group, though it is part of your group for all practical purposes, but for corporate tax purpose, that is going to be considered as a separate entity. So you need to make sure that the transactions are accounted properly, the value of the transactions are properly arrived to, and that is at arm's length. And if you have an entity which is part of the free zone and that is eligible for qualifying free zone person, that also should be accounted separately, and all the compliances required to get the eligibility for corporate for qualifying free zone person should be taken care. If you have transactions with your group for with that particular prison person, you need to make sure that that is at arm's length. So all those precautions you need to take care of. If you have any domestic permanent establishment or foreign permanent establishment, then that should be treated as a separate entity for corporate tax purposes and accounting of those transactions, and they should be at arm's length and all, so that we need to take care of. Double taxation, the DTAs and DTLs, deferred tax asset and deferred tax liabilities. There's a possibility of having these DTAs and DTLs on your uh, opening numbers, so we need to make sure that that is being calculated properly and accounted in your balance sheet or disclosed in balance sheet properly. And in your financial statements also, the relevant notes and all should be properly mentioned as per IFRS. The income taxes standard is going to be applicable, as well as other relevant disclosures need to be taken care of. So these are the important points that you need to look at when you go or move into your first tax period. Next. Yeah, so with respect to record keeping, when you move into first tax period, what are the important ones to you need to look at? Like, you need to have your proper financials and fixed assets register should be updated properly. You have to have your employee records updated, and inventory records also required to be updated, and your closing balance of previous year becomes opening balance. So your closing balance of your inventory should be properly valued and properly accounted in your books of accounts. Any adjustment that you have is expected to be adjusted and accounted properly, so that in the first tax period and then following periods, it's not going to have any issue. If you have any licenses and intangible assets and all those things should be valued properly, accounted accordingly. If you have to look at your agreements with your customers and suppliers, if you have any clauses which are impacting your value, and also if you have any clause with respect to taxes that need to be relooked at and make sure that that is addressed properly. And the documentation with respect to transfer pricing. If you have any transactions with your related party or connected persons, so the transaction should be at arm's length, and documentation with respect to that particular transaction, and also documentation to demonstrate that those transactions are dealt with at arm's length should be taken care of. Anytime if FTA asks you the basis for your transaction value, you should be in a position to demonstrate that based on your documentation. And if you have to maintain any additional records in order to comply with corporate tax requirements, you need to maintain that. You need to look at that and then evaluate any amendments to your current records. If you are not maintaining full set of books of accounts, you need to make sure that you are maintaining the full set of books of accounts properly. And now, so far we only had books as proper like books of accounts, as well as transactions or set of records for VAT. Now we also need to maintain some set of records for corporate tax purposes, especially the reconciliation between your profit as per books of accounts versus your taxable income. So that reconciliation you should be able to demonstrate and have support, proper supporting documents. Not only that, when you go forward, if you have any losses, so you have to carry forward the losses. If you have any interest which is not fully accounted as expense in first year, so you may have to carry forward that. So the documentation with respect to all these carry forwards and then adjustments you need to maintain properly. You should be in a position to reconcile the taxable income with the profit as books of accounts. If you require any training requirements for your finance team and people who are involved in the taxation and all, you should make sure that you have enough training given to them. And if you have to look at your standard operating processes, you need to look at them and then make necessary amendments and adjustments in your SOPs, considering the requirement of corporate taxes. Since most of the companies will be having ERP and other accounting packages, if you have to make any changes in ERP and accounting packages to incorporate or to bring in the requirements of corporate tax, you need to look at that. Yeah, next. So, what are the other action points? We have looked at these briefly in previous slides also, but yeah, you need to make sure that your company is registered in time. Given the deadlines they have given based on the month of the issuance of the licenses of each company. If you want to avoid the penalty of delay in registration, you make sure that you register the company before. And you need to make sure that whatever is required to make or to be able to file your corporate tax return, without having any issues. You need to make sure that your books of accounts, your chart of accounts is updated properly. You maintain the books of accounts according to the requirement of the law. TP compliances we've discussed in the previous slide. Overall compliances readiness. Like if you have any related party transactions, you may require to have disclosure form to be filed. Master file, local file requirements will be there if your turnover is more than 200 million dirhams. So you need to make sure that you are compliant with all this and you are being ready with all necessary information and documentation to be able to make sure that the files are ready and filing can be done without much hassle. If your turnover is more than 3.15 billion dirhams, then you will be considered as multinational entity for CBCR purpose, country by country reporting. So then you have additional compliance and as well as document to file in the form of CBCR. So that also you should be ready to be able to file. So maintenance of books of accounts, maintenance of sufficient information, and making sure that you are understanding the requirement of corporate tax, and then making necessary changes to your chart of accounts, your books of accounts, and then other documentation is going to be important. So for that, all awareness and trainings are very, very important. Taking the advices from people who already are aware of these requirements is also going to be important. So these are the few important elements that you need to look at to be ready for to be able to handle the corporate tax requirement. Next slide. Yeah, so this is what we wanted to bring up to you guys. If you have any questions, definitely you can ask us, or you can drop in your questions in the uh, chat box. So if you want to reach out to us, so the landline number is given on that. As well as you can also reach out on our info mail ID, and you can visit our website also. We publish a lot of blogs on different topics, and you can refer to the topics. And then if you need any assistance, definitely you can reach out to us. As I mentioned, we provide corporate tax services. In addition to that, we do accounting, audit, value-added taxes, company formation, economic substance regulation, anti-money laundering related compliances. So all these compliances we help with our clients. And you can reach out to us anytime. I see some of the questions that are already in the chat box. Let me just read them out. Is the corporate tax applicable for free zone entities? The answer to this is yes. Yeah, the corporate tax is applicable for free zone entities also, along with offshore entities. The only thing is that for free zone entities, they are given 0% corporate tax benefit also. Of course, subject to meeting certain conditions. If you become a qualifying free zone person, then if you have qualifying income, yes, your income is going to be subject to tax at 0% tax. If not, then you'll be subject to tax at regular corporate tax rates. So the regular corporate tax, as we know, 0% tax up to 375,000 dirhams profits or taxable income rather, and 9% corporate tax in excess of that amount, 375,000 dirhams. So that will be subject to tax at 9%. Yeah, so I see the reason. Yeah, they generally your original cost will be higher than net book value. I don't see any other instance. At least I don't know. I'm not sure about the instances where you'll have net book value higher than the original cost. Uh, yeah, I'm not really sure about it. Okay, so uh, yeah, so once again, we just want to thank you all for attending this session, and we will share the video recording of this as well as the presentation for your reference. If you have given your email ID already, if you're not given, you can leave your email ID here in the chat box. We will share the video recording as well as presentations with you. So as I mentioned, you can reach out to us anytime if you have any other question. So thank you all for attending this session and have a great day.